All righty. Well, good evening, everybody. Thanks for joining us tonight and to go through our second round training, I guess I would say, on the employee retention tax credit. So I'd like to go ahead and start us off this evening with our collect for the fourth Sunday of Easter. So let us pray. O God, whose Son Jesus is the good shepherd of your people, grant that when we hear his voice, we may know him who calls us each by name and follow where he leads, who with you and the Holy Spirit lives and reigns, one God, forever and ever. Amen. So good evening. I hope you guys had a great Monday. I know we had a fun one. I have a little helper here who we picked up down in North Carolina who's been helping me out today. So this is Dottie. So she's been keeping me busy today. She's a good little girl. So she's been, she's a 2-month-old. So 2-month-olds are who they are, but she's a lot of fun, very sweet little puppy. So on that happy note, I will get us launched into our time together on a much less cute subject, employee retention tax credit update. So let me just get into where I want to be on this. There we go. So just to give a little bit of background again on the governing law behind the ERC. It started actually over a year ago with that first CARES Act that established the PPP program that we've all become so familiar with now. And then the ERC was actually a part of that act, although it wasn't part of it that we really paid too much attention to after the initial information came out, because at that point in time, it was mutually exclusive with the PPP. You could do one or the other, but not both. So the choice became which one has the most benefit. And the way that the ERC was structured at that time, compared to the way that the PPP program was structured, the PPP grants were much more beneficial for the overwhelming majority of our congregations. And so we didn't really pay too much attention to the ERC. And then all of a sudden at the end of last year, with the what they now call for short the Relief Act in December of at the end of December of 2020, the ERC was expanded and it was extended through June 30th of 2021. It originally was only for 2020. But they also expanded it to the major change that occurred with that particular act was that you could now take advantage of the ERC even if you already had received a PPP loan or a PPP grant. So that was the biggest change, that now you could do both rather than having to do one or the other. And there's some limitations around that we'll get to when we talk in more detail about that. But that was the first thing that put the ERC back on my radar anyway, and a bunch of other people's as well. And then with the American Rescue Plan Act, the ARP Act in March 11th of this year, it further extended the ERC through the end of 2021. So that's sort of the sequence of events that brought the ERC back to our attention, whereas it had kind of fallen off our radar before. So again, why the ERC? Why now? The ERC is now one of the most beneficial provisions of the Relief Act relevant to nonprofit organizations. Again, principally because you were, if you weren't eligible in 2020 because you took out a PPP loan with intentions of having it forgiven, now you are eligible because they are no longer mutually exclusive. So That's a real powerful reason to consider the ERC for 2020, because again, in the act that that made the ERC available, in addition to the PPP, also made it retroactively available in 2020. So the ERC is something that you can claim retroactively from 2020 forward, but then also proactively in 2021. And again, as we look ahead in 2021, we'll see that there have been some changes made to the amount of the credit itself that makes it even more beneficial, about 4 times more beneficial than it was when it was originally conceived in 2020. And you'll see on some of these slides here where I've taken these, where I've taken this information from my research sources. You'll see those down at the bottom with the links. I also have a slide at the end of this presentation that has all of my sources on it. And this slide deck actually is already available on the website. If you go into the COVID-19 section of the website, in the particular section on financial information, you have to kind of scroll down all the way below the information that we've been accumulating on the stewardship, stability, and sustainability workshops, and you'll see a section in there just on the employee retention credit. And this slide deck is in there from 2 weeks ago when I did the first presentation on it. So it is available to you, and it is linked, so you can go to the same links that I did if you want more information there. So as with most of these kinds of provisions, the next question that comes up for all of us is, are churches eligible? And, you know, because again, a lot of times just because a nonprofit is eligible doesn't necessarily mean a church is. But from the same source, which is BDO, is a very well-known accounting firm, international accounting firm, and they have a specific section that's just all about nonprofit. There's a specific practice on nonprofits and educational institutions, and that's where this came from. But so, you know, according to what they had to say, you know, they did start out with tax exempt organizations are eligible for the ERC because they are deemed to be engaged in a trade or business. In all of the IRS language around the ERC, you will hear them, you know, making reference to trade or business operations. And that tends to throw us off sometimes because we do not think of ourselves as a trade or business. But they give specific examples of nonprofit organizations that have already taken advantage of the credit, including churches. And yes, churches most definitely are eligible for the ERC. When you see that language, if you happen to go back into some of the research and you see them talking about trade or business operations, you can just, in place of trade or business, just in your mind, substitute the word church, because church operations do qualify. The ERC is what they call a refundable payroll tax credit. So any kind of a IRS credit that is termed refundable means that when you calculate the amount of credit that you're entitled to, even if you don't have enough in payroll taxes in this particular case to offset that credit and get a, you know, even if you can go beyond just a refund of the payroll taxes that you've already paid in and get the balance of it refunded to you, you know. So an example of a refundable tax credit on your income tax return would be the earned income credit. When you calculate, you know, if you qualify for the earned income credit, you could literally have not paid any taxes you could have had no withholdings and paid no taxes in the entire year. And if you qualified for the earned income tax credit, you would get a refund of that amount that you qualified for, even though you paid no taxes. That's what a refundable credit is all about. And the ERC is a refundable credit. So when you calculate the amount of the credit that you qualify for, even if you didn't, let's just say you're going back through 2020 and looking retroactively, and you calculate that for 2020, you could have a credit of $10,000. And for the amount of the year that you qualify for, you only paid in $8,000 worth of payroll taxes with your 941 forms, or however you pay them in. You would be entitled not only to a refund of the entire $8,000 that you'd already paid in, but you would also get the extra $2,000 over and above the payroll taxes that you paid in, because your credit, the full amount of the ERC is refundable to you. So that's what it means to be refundable. And it's calculated based on wages paid and health coverage. So when they talk about wage costs, that's the terminology that they've used pretty consistently in the language of the law. Wage costs do include health coverage, and the employers who qualify are employers whose operations were either fully or partially suspended due to a COVID-19 related governmental order. So think about, things like when there was, when Governor Murphy initially basically eliminated in-person gatherings and then, loosened it up, but there are still restrictions on in-person gatherings. That's an example of operations, in our case, worship operations, building rental operations, fundraising operations that were either fully or partially, because they do continue to be partially suspended due to a COVID-19 related governmental order. So that what I just went through was criteria number one. Criteria number two is that you've experienced a significant reduction in gross receipts, but you only have to use one of the criteria. You don't have to meet both of them. And so then the next, step that we have to take from this particular definition of the ERC is, just to kind of ask, okay, well, what does it mean to be partially suspended? Operations being partially suspended, because again, even though we had our operations, our in-person worship, basically fully suspended and now partially suspended, that doesn't mean our worship was completely suspended, because we just went to virtual worship, or a lot of us did. However, I think within that, we would all agree that, even now, even though we're allowed to be back in, at least partially in person, and we're continuing to do virtual worship, that doesn't mean that we're back to the kind of full operation that we would be experiencing if those governmental regulations were not still in effect. And so that's where each congregation basically needs to do that evaluation and make sure that you can, and document it, because it's important as you're going through this analysis of deciding, what constitutes partial suspension of your operations. Document it so that then if a question ever comes up down the road about whether or not your operations were partially suspended, you can show that you went through an analytical process before you ever even decided to take the credit. That was based on, the whatever criteria that you're using, and so that way you won't have to, first of all, you won't have to try to remember, because if you get audited and it's 3 years down the road, it's, there's going to be a lot of water under the bridge between now and then. But second of all, you're demonstrating to the IRS that you didn't just kind of say, oh, yeah, well, here's my calculation, I'm going for it no matter what. You put contemporaneously, you put thought into, into this requirement, and you documented it, and you cared enough to do that. So you were you had your due diligence enough to do that, so that even if they happen to disagree with you about your final conclusion, about whether you were partially suspended or not, they would never, they would then not further assess any penalties or anything like that, because you didn't go through the proper procedure when you first were doing the analysis. So it's always good to document the analysis that you're doing on a contemporaneous basis. So again, kind of just back through what we were talking about, it's claim the ERC, and the ERC is claimed on a quarter-by-quarter basis, just like you file your 941 form on a quarter-by-quarter basis. And so, your church has to meet the one or the other of those criteria during the quarter for which you're claiming the credit. So, you're thinking, so you would essentially be thinking about, if you're going back into 2020, for now, I'll use the example of the second quarter of 2020. You would look at that quarter and say, were my operations fully or partially suspended as a result of orders from a governmental authority? Well, that pretty much was right after we received the initial basically shutdown orders. And so chances are that the answer to that question is going to be yes. But you have to ask yourself that question in each subsequent quarter, third quarter, fourth quarter, and then going into the first and second, third, and fourth of 2021. We have to continue to ask ourselves, do we continue to have our operations partially suspended during this quarter? So you do need to do that on a quarter-by-quarter basis as you're moving forward. I want to go, let me go here. As a further definition of what it means to be partially suspended, I went to a different source. This was another very, large, well-known accounting firm that has its own nonprofit practice. This is the way that they described it. They say certain businesses may be indirectly affected by a governmental order, although they are allowed to operate. It depends on whether the suspended activities make up more than a nominal portion of the business. And they're taking this description from the IRS notice 2021-20, which has a lot of FAQs in it. And it references these two specific questions, or the answers to these two specific questions, where the IRS references nominal to mean less than 10% of either the total gross receipts of and they say business, but we can read that as church operations, or the total hours of service performed by all employees. So, in this particular case, what we would be looking at is that if the impact of the suspension of activities, so having to go to virtual worship or some combination of virtual worship and in-person worship, and I shouldn't even just say, worship, because a lot of this really impacted us in other areas like building rentals and fundraising activities and, just the normal course of faith community activities. If you were impacted more than 10% of either the total gross receipts of your operations or total hours of service performed by your employees. So thinking about things like, if you had a lot of your building operations suspended, then, chances are, even though you may have, tried to continue to pay your sexton, because that's what this is all about, is trying to retain employees. The total hours of service that person is performing may have been drastically reduced. And again, when it comes to a 10% impact on gross receipts, that does include everything that you would normally include when you're considering your PPP loan amounts. When we were talking about, well, what kind of gross receipts do we have to include in that gross receipts test? It's the same kind of stuff, your pledge and plate plus building rentals plus interest and dividends and, any other types of income you may have coming in. But that the 10% threshold is really, again, it's nominal. So I think that still leaves a lot of room for a lot of us to be able to consider that our activities have been partially suspended due to the government rules that are in effect that impact us. So the other thing that particular IRS notice 2021-20 does is it gives a lot of helpful examples, which may help put some context around our own thought processes and analysis. So here are just a couple of them. There are more. And I did include in my sources at the end, a link to the IRS notice itself, so you can read through some of them if you want to. But here's a couple. An employer such as a food processing plant is required to devote several hours a day to cleaning due to enforced health regulations. They consider that a partial suspension of activities, just merely by virtue of the fact that they have to, they have to close or, cease operations several hours a day because they've had to change their cleaning methods. That is considered to be a partial suspension. All the rest of the time, they could be, operating at full capacity. But, this is enough to consider it a partial suspension. And an employer that is allowed to continue to operate during a governmental order, which again, that applies to us because we have been able to continue to operate, but has to suspend a more than nominal segment of its business. And for many of us, our building rental activities are a more than nominal segment of our business, so to speak, our operations, is considered to be partially suspended. And the example that they use here is a hospital that does remain open but can't perform elective surgeries. That is considered to be a partial suspension. So again, there's some helpful examples there that can guide us in our thinking as to whether we would consider ourselves to have had a partial suspension or not. Again, I make the point here that each situation is unique. The facts and circumstances dictate whether a business is fully or partially suspended. And, you have to do that thought process here on your own regarding your own facts and circumstances. But from what I understand of, and what I've been hearing back from so many of you about the way that operations have been impacted by the switch to first completely in-person worship and shutdown of all building activities, and then this gradual move back towards partial in-person worship, and in some cases going back to some types of building rental activities. I really believe that the partial suspension aspect does apply to us, to many of us. And then if, excuse me, if you feel as though you don't qualify under the partial suspension criteria, there is a second criteria, which to my mind, although in your circumstances it may be different, but to my mind is much more difficult to meet. And that is the reduction in gross receipts during the calendar quarters compared to 2019. So this is similar to when we had to show for PPP purposes that we had a 25% decline in gross revenues. You use the same types of receipts when you're doing this comparison. So you would be basically comparing all the types of revenue that go into your operating budget in a particular quarter of 2020 against 2019. And for that comparison, between 2020 and 2019, those gross receipts have to have declined by more than 50% when you compare it to the same 2019 quarter. That's when you would begin for that quarter, you would be eligible if that happened to you, if you had a decline that substantial between 2020 and 2019, you would then qualify for the ERC beginning in that quarter. And then you would continue to be eligible for the ERC through 2020, through the 2020 quarter, in which gross receipts rebound to become once again greater than 80% of the gross receipts in the same 2019 quarter. So if you had that kind of drop off a cliff, basically, and then your gross receipts rebounded throughout the rest of 2020, you would still continue to be eligible for the ERC until those gross receipts are greater than 80% of what they were in the same quarter of the last year. So that's a bit more difficult of a criteria, I think, for a lot of us to meet. And then that same revenue reduction criteria changes a little bit in 2021. So that gross receipts eligibility threshold now becomes a 20% decline in gross receipts for the same calendar quarter and again, you're comparing to 2019. So you're kind of skipping across 2020. You're comparing your calendar quarter in 2021 to the same calendar quarter in 2019. And now it only has to be a 20% decline. So that would, it's a little bit less stringent, but still, I think for some of us, not as easy a criteria to prove as a partial suspension due to governmental order would be. So that would be, really, I think my advice is really just take a good hard look at that partial suspension criteria and document the ways that you would meet it. Use that criteria rather than having to go through the revenue reduction one. I think you'll have a lot more success there. And so before I get into, actually the mechanics of claiming the ERC and how it coordinates with the PPP loan grant program, does anybody have any questions on the part that I just went through? So either I explained it really well or I completely confused everybody. I'm not sure which.
Well, I put my question in my text.
Oh, in the chat? So yeah, I did see that. So part of, documenting the service, the services that you've had would be a part of sort of, demonstrating the impact of having had to abide by that governmental order. That it is but that's only a piece of it, I guess, is what I'm trying to say, is that, in-person worship is a piece of it, but you had to shut down basically everything that was happening in your building, whether it was rentals, whether it was other group activities, even just some of the fellowship that, we Bible studies, things like that. Not all of that immediately went virtual. So, all of that stuff that was immediately impacted by the complete shutdown and then has only been sort of mitigated by the fact that we can now do at least some degree of in-person worship. The group that was on this morning was pretty much unanimous in saying that even for those who have begun to do outdoor worship, where you really don't, if you're doing indoor in-person worship, you still have restrictions because of physical distancing that has to happen. So you can't bring everybody back into the building. And so you still have lots of people worshiping virtually. But even with all that said, you're not back to the full steam capacity that you were at when, or at least that's what I was hearing from this morning's group, is that, people are still, even with the outdoor services, not everybody wants to come to an outdoor service, so they may still, prefer to attend virtually. And a lot of what's happened with the virtual services and the outdoor services is instead of having an 8 o'clock and a 10 o'clock, now there's one service. So all of these things have really continued to impact the capacity of that we have to be able to continue our operations. They are definitely not our operations the way that we would be doing them if we had no threat from COVID. So that's really kind of what we're looking at. So yes, the virtual worship is part of it, and documenting all of that stuff is part of it. But it's not the whole picture either. Did that answer your question, John? Oh, okay. Anybody else? Alrighty, so as I mentioned before, the ERC is to be considered and claimed quarterly, and it's with the intention of helping with the cost of retaining employees. We as employers can use our ERCs to offset federal payroll tax deposits, and also to credit against formerly filed 941 forms, where we already have actually made the federal payroll tax deposits and had them credited against the federal payroll tax liabilities that we have. So, so the ERC can be used to offset all of that, including, as you would expect on a 941 form, the employee FICA and income tax withholding components of those deposits in those forms. So the one thing that comes into play there is that there are a number of congregations now who, I think it's actually growing more and more common, that the clergy request to have income tax withheld from their pay to help them with their tax liabilities as of the end of the year. There's a larger amount there to claim the credit against, because you've got that income tax withholding that's taken place. That is one benefit that we have in being able to claim the credit this way. However, having said that, it is also, as I mentioned, worthy of noting and reinforcing that the ERC is a refundable credit. So even if you don't have enough employee FICA and income tax withholding liability to offset, the amount of the credit, that excess credit you claim as a refund anyway. So you get, not only do you get a reimbursement of whatever payroll tax withholding that you've already paid in, you can get a refund of any amount that's over and above that liability. That's what the ERC is all about. So, okay. So again, unlike the PPP, which was on a first come, first served basis, the ERC, because it's all operating on payroll tax credits, can be claimed for up to 3 years from the date in which a quarterly payroll return was filed. We have some time on this, that we're not as stuck on our deadlines as we were with the PPP. And this last provision really is for small employers who are experiencing a lot of hardship, a lot of financial hardship. If they really needed to, could request an advance payment of the credit, subject to some limits, on a special form 7200 that could be filed with the IRS to try to get the money even in advance of their getting their amended 941 forms in, or they do have to have first reduced their employment tax deposits. But that's kind of an extreme hardship situation. And it's questionable how well that's really working anyway, because again, based on a lot of the conversation that we were having this morning, it's pretty evident that the IRS is struggling with all of this anyway. And even getting the refunds out for people who are now amending their 941 forms to claim the amounts back, the processing times on those are not super quick either. So the other thing that we need to take into account, again, when we're looking at this on this quarter by quarter basis, is how does this coordinate with the PPP program? As I mentioned before, initially you couldn't do both. But then when the Relief Act came into existence, and you could do both, the one thing that they did make clear is that you can't use the same payroll costs for both. So whatever payroll costs, and so in other words, it's a no double dipping provision. That's the easiest way to say it. So whatever payroll costs that you either have used or will use to apply for forgiveness for your PPP loan, you cannot use those very same payroll costs as part of the calculation of your employee retention credit. However, keeping in mind that with the PPP loans, there was, anywhere from an 8 to 24 week period, and anywhere in that range of payroll costs, that still leaves us a lot of payroll costs that we are not using to offset PPP loans or to apply for forgiveness. The thing to remember here is you just have to keep them separate. You have to be really clear about the period that you're using and the payroll costs that you're using during that period for forgiveness for your PPP loan, and keep them separate from the payroll cost, keeping in mind in both cases, we're talking about health insurance as well as wages. In order to, and in the case of the PPP, you're also allowed to include pension. So you're just keeping those in two separate buckets. You got your PPP bucket over here. You've got your ERC bucket over here, and you can't, double dip in both buckets. They have to be kept separate. So that's one thing that we really do need to keep in mind. And so the point that I'm making here is, that some strategic planning is going to be needed in order to make sure that you generate the maximum benefits from both. Now, we're still in a position where we have quite a number of our congregations who have not yet applied for forgiveness even for the first round loans. So there's some planning opportunities in there now. Some have, and some have already received forgiveness for the first round loans. However, from what I've seen, I think any congregation, regardless of whether you have already, determined what your PPP bucket of wage costs is or not, there's still room for benefit, for the vast majority of our congregations. And so again, we do this strategic planning on a quarter by quarter basis. We determine, the wages on this quarter by quarter basis. We determine, we first take a look at the wages that are paid to our employees. And because we are considered to be small employers, because we have less than 100 employees, then, we can claim a credit against all wages paid to employees. If we were a large employer, then there's a limitation on which employees qualify, whether they were actually working or not. But we don't have to worry about that because we're small employers. So we can claim a credit within the appropriate limits, and we'll talk about them in a minute, for all wages paid to employees that were not used for the PPP loan. And then also remembering qualified healthcare expenses count as wages for purposes of the ERC. Again, not as long as you did not use them already for the PPP loan. And whoops, I don't think I wanted to go there quite yet. Yeah, I guess actually I did. Let me go there first. And so again, just to kind of go over the changes, this is kind of a helpful table to show us the changes that were enacted that make the ERC now such so much of a better benefit for us than it was before. As we look over here in the prior law, so this was the law that came into effect with the CARES Act way back in 2020, way back in early 2020. You couldn't get the ERC if you were going after for forgiveness for your PPP loan. The maximum creditable wages per employee were $10,000 per year. And the maximum credit you could claim on those creditable wages was 50%, which meant that the maximum credit you could get would be $5,000 per employee. And again, as I mentioned, the threshold to be considered a large employer was more than 100 employees. So then comes along the end of, the end of the year, and under the new law, now you can get both PPP loan forgiveness and qualify for the ERC, but you can't double dip and use the same wage costs for both. For the looking retroactively now into 2020, okay, because this provision was retroactive to 2020, the maximum amount of creditable wages for any calendar quarter in 2020 or any, for the period of 2020 was still $10,000 per year. Okay, same as before, credit was still 50%. So you maxed out at $5,000 per employee that you could take. And again, our large employer threshold stayed the same. So that's looking retroactively. Now that you can take the credit for 2020, you're limited to $10,000 per year per employee of creditable wages, and you're limited in your credit to 50% of that amount. So again, now when we take a look at this in side by side with a first round PPP loan, chances are that at least to some extent, you've got, you would have wages available that you did not use as offset, to get your PPP forgiveness. Up to $10,000 per year per employee that you could use to claim the credit. You just have to be careful about making sure you keep your buckets separate and your time periods separate. So then we see, though, now we're moving forward into 2021, and we can see that now our maximum creditable wages per employee have increased by 4 times, because it's $10,000 per quarter per employee. And also the amount of the credit has increased from 50% to 70%. So now you've got a maximum of $40,000 per year per employee, with a credit of 70% of that available, which would mean you would max out at $28,000 per year per employee. If you were able to use the maximum amount of creditable wages per employee. And now our large employer threshold has moved up to over 500 employees. So that's really what has made this so substantially better, than it was when it first came into existence. And again, in 2021, so many of us are looking at a second round PPP loan. And again, the same thing would apply. You just can't double dip. You just have to keep your PPP wage cost bucket separate from your ERC wage cost bucket. So that's, basically how that would go. I didn't want to do that quite yet. I've got one more thing I want to go through here. I mainly wanted to, and I see, John, your question in the chat about PPP2 being calculated, and I'll cover that in this next section that I'm going to go through. This is sort of my own summary of, suggested strategy and steps to take as far as managing how you apply for the ERC. And, again, the first piece of it has to do with really clearly understanding your PPP covered period options and how they affect your forgiveness application deadline. So especially for those of you, this is mostly for those of you who have not yet applied for forgiveness. Those of you who have and hopefully have already received it don't really need to worry about this section because you've already taken care of that. But for those of you who have not yet applied, you have some flexibility in the period that you're using, but you also have to understand how it impacts your application deadline, just to make sure that you don't inadvertently get yourself with too short of a period. And now your application deadline has already passed. And so now you actually have a loan instead of a grant. because, I quoted the language from the SBA website up there. If you don't apply for forgiveness within 10 months after the last day of your covered period, then your PPP loan payments are no longer deferred. They become due. You now have a loan, not a grant. And so the example given down below is intended to illustrate that, when we look at our covered period, we're looking at it based on the date of deposit of our PPP loan. So in this particular example, we're looking at a May 4th of 2020 deposit date on a first round PPP loan. If you were to say that if you're trying to now determine what your PPP bucket is going to be, and if you were to say that I'm going to use an 8-week period, because I know I can cover all my payroll, I can cover my forgiveness costs in that 8-week period. Well, that 8-week period would have ended on June 28th of 2020, 10 months from June 28th, which would be your application deadline, which would be April 28th, which is 2 days from today. I wouldn't recommend that. So, but conversely, if you take it all the way out as far as you could possibly go, and this is really to kind of answer your question, John, because this is the same for PPP2 as it was for PPP1, although it took a couple of iterations for PPP1 to get there. You have a choice of a range anywhere between 8 and 24 weeks. It doesn't have to be 8. It doesn't have to be 24. It could be 10. It could be 13. It could be 17, and so that's where this flexibility comes in that, in the example that I have in front of us here, the longest it could be would be 24 weeks. So the end of a 24-week period from May 4th in this example would have been October 18th of 2020. 10 months from that date is August 28th of 2021, which would give me, still plenty of time to apply for forgiveness. And so, as I mentioned down at the bottom, you could choose any period of time within that range as the covered period. And then just make sure that you know that. That's the first step. Nail that down. And make sure that you know what your application deadline will be so that you can make sure you get your application in. So that's and especially, as we're looking retroactively into 2020, once we decide that, then we can decide how we're going to move forward with the ERC calculation. So I see your comment. It might be good to get forgiveness on PPP2 before applying for ERC in 2021. You can, but again, as long as you know what what costs you need to achieve forgiveness and what covered period you need to get that, you're basically just segregating the costs to make sure. But if you're more comfortable waiting, as I mentioned, with the ERC, you could go through the entire year of 2021 and continue to make your payroll tax deposits and file your 941 forms and go through the process of getting your forgiveness on your PPP2 so that you know which cost you used to do that, and then go back and amend your 2021 941 forms if you wanted to do that. You have 3 years from the date of filing of the form in order to do that. You could literally be, working in 2023 or 2024 on amending your 2021 941 forms. So yes, if you're more comfortable waiting until your forgiveness process is complete before you go ahead and decide how much of that year's cost you have left to be available for the ERC and then applying for it through your, amending your 941 forms, that's a perfectly acceptable process, to use. So then moving forward from here, I kind of just covered a little bit of what I was talking about. If possible, holding off on forgiveness application until you do this analysis, because you're trying to get the maximum benefit from both. The one thing that I hadn't mentioned up to this point that we all have to bear in mind with our PPP forgiveness application is that you need 60% of those costs on that for forgiveness to be payroll costs. So within whatever range, whatever covered period you have, the one thing that you can do is you can maximize the non-payroll costs. So this is another, step that I have in here in the process is, you can have up to 40% of the costs that you are using to apply for PPP forgiveness be non-payroll. So within that, let's say you choose a 10-week period, then you would look at that 10-week period and try to maximize the non-payroll costs, then figure out how much do you have to, how much of your payroll costs do you need, and basically minimize them so that they are, as close to that 60% as you can possibly get them. And then you would have the other payroll costs that you weren't using that would still be available for you to use for the ERC. So that is some of the strategizing that you can do when you're looking at the costs that you have within your covered period. So I see you said, may have left some non-payroll money on the table for PPP1 forgiveness. Amending that, I think, would probably be a bit of a nightmare. I don't know if I'd want to go down that road. I don't even know if the banks have a process for doing that, because I think what happens with them is, again, once they get your application, they forward it, they vet it, obviously, and they ask you any questions they might want to ask, but then they forward that on to the SBA, and it's the SBA who actually forgives your loan, not the bank. So I think amending that particular process would be a bit of a nightmare. So if there's not much of a cost benefit analysis there, I wouldn't, that would probably not be a productive use of your time. So then, as I mentioned, to the extent that payroll costs and or healthcare expenses were not used in any calendar quarter for PPP forgiveness, then use them to calculate the ERC. Part of, again, the reason that it's important to think about this on a quarterly basis is that my bet would be that whatever your covered period is, it doesn't jive with calendar quarters. So for example, in last year, using that date that was used in the prior example of May 4th, and being when the loan proceeds were actually deposited, then that means in the second quarter of 2020, in that particular example, you had payroll costs in the month of April and all the way up to May 4th that were not used for PPP forgiveness because you didn't even have your loan yet. So you could use those payroll costs to calculate the ERC for whatever those would have amounted to for that quarter. And then if you're using the rest of that quarter's expenses to help with your PPP forgiveness, and then when you get to the end of your covered period, again, my bet is it's going to stop somewhere in the middle, of a calendar quarter. And so the rest of that calendar quarter, you would have some payroll costs and healthcare costs that were usable for the ERC. So that's why you have to kind of take a look at this stuff on a quarterly basis and literally look at what did I use for my PPP and, what did I have left over from that quarter, and to figure out. And then what you do once you figure that out, you implement the credit. This isn't something that you have to actually, apply for, to the IRS. The way that you implement the ERC is you do your own calculation, and then you go ahead and amend your 941 forms retroactively for any prior quarter that you qualified for. And then, using any credit on the 941 forms for future quarters in which you qualify. And you've probably already seen on the 941 forms where they have a specific line, I think it's like line 13 or something down at the bottom, where it deals with the application of the ERC. It's specifically on there. And then you have a choice as to whether you're going to push that credit. If you end up with a net credit on the form, you have an option as to whether you want to push that net credit forward into the next 941 form or actually get a refund of it. And so, as I mentioned down at the bottom, obviously this involves some coordination and consultation with your payroll company if you've used one. So once you've done the calculations, then you have to, give the directions to your payroll company as to how you want to see the credit applied. I think that's, basically it for that. The last slide that I have here is, as I promised, my sources and resources for the information that I have in the presentation here. So with that said, any questions, comments? How do we consider returns to normalcy? I see that in the chat. Can you say more about that, John? What's the answer to that question?
I mean, as we start letting groups back in, as we start meeting on the campus again, when do we fall out of the partially suspended category and go back into you're back to normal? So again, if let's say this year, December, all of our renters are back, all of our self-help groups are back, our food pantries back operating in the space it was in before. I guess that's my, because right now we're pretty much shut down. There's nothing going on on the campus, and we do food pantry out the door out the door. No one comes in anymore. So I guess that would be my, who's going to be judging that? Oh, you're back to normal. You don't count anymore.
Yeah, I think, first of all, you're going to be the ones judging that. And when I say you, I don't necessarily mean just you personally, but, if you've got whoever you're working with in your financial teams there at your congregation. And, after you've done that initial analysis that really gives you the comfort level of where you are, where you were last year, where you are now, continue to go back to it and think about what they defined as nominal. They use that 10% number. And when you feel like you're getting to the point where your operations are almost 90% back to normal, whatever that might constitute, or if you're getting close to that place, that's when I would say, that you would cease to claim the credit. So if that doesn't happen before, right now, the credit is only good through the end of 2021 anyway. So if that doesn't happen before the end of 2021, then then you've got your answer. But if you do start, as you said, maybe in the fourth quarter of 2021, start to be approaching that place, depending upon how vaccinations are going and what kind of restrictions get lifted and all that kind of stuff. If you're really getting to the point where you're approaching being 90% back to where you were, and I won't say back to normal because who knows what normal is going to be, but, if you're getting close to 90% of the capacity of operations that you were doing before COVID hit, then it's probably a good idea to say, okay, enough, we got our benefit and we're done now. Okay, can we get a PDF copy of the presentation? Certainly, yes. I can make sure that what I'll do, I think the one that's posted on the website right now is a PowerPoint. But when I'm going to go ahead and post the recordings from these sessions along with the slide deck again, and I'll make sure we get a PDF of the slide deck up there as well on the website. Happy to do that. Any other questions? Alrighty, as I told the group this morning, one of the things that I really would love to do, and I would love it if it would happen with this group as well, is for us to, between now and 2 weeks from now, which is when we'll have our next series of these workshops, the financial resourcing workshops, go through the calculation, start to get to work on it so that you actually go through, some of the computations, come up with your questions, areas where you got confused, things like that, and bring them back with you. Or maybe just if you didn't get confused, then bring that back too. And we're going to share some of these examples with each other. As far as, the different ways that we find to coordinate, especially the ERC with the PPP, and, so John, now that you obviously you already kind of came to that realization that, maybe there was some money left there on the table, so already you're starting to do that comparison in your head already. And maybe just, you can talk with us a little bit about that, the next time around. Well, if I had it to do over again, maybe I would have done this, just to kind of help all of us understand, getting through some of these calculations so that we can share that with each other. And again, bring your questions so that we can hopefully get them answered as well. So that's really going to be, I think, the focus of what we're going to be doing 2 weeks from today when we do these meetings again. And I would really be very grateful for as many of you as possible to come back, regardless of whether you've actually done the calculations or not, just to listen and learn, if nothing else, because there are always, everybody's situation is a little bit different, and we always learn from listening to each other. So I would love to see you back in a couple of weeks, and we can go through that in a little bit more detail. Sound like a plan?
Yeah, I just wanted to say this is the second time I've been through this ERC, and it's becoming a little clearer, at
Good.
least that we could use April to calculate for the second quarter of 2020, but the rest of our quarters, I'm not sure. I would have to do calculations on that, but it would be excellent if we had the PDF, because especially that one slide where you go through all the changes in the law, that one would be really helpful.
Okay, great. Yeah, no problem at all. I'll be happy to do that. And the one thing I did forget to mention too is that going back retroactively, it's in the slides. I think the date came up, but I just didn't highlight it when I was going through, is that for when you go back retroactively into 2020, we can only go back as far as March 12th. So we effectively only have the last 3 quarters of 2020, although if there would be a couple of weeks there at the end of the first quarter that you could also claim if you wanted to. So I just wanted to make sure you guys were aware of that as well. Alrighty, with that, I will say good night, good evening, and hope you have a good rest of your evening. And I will look forward to hopefully seeing as many of you as possible in a couple of weeks. Take care.